Okay, investments, chapter 13, equity valuations. We're trying to figure out how to value the equity in an organization. There's obviously more than one method to do so. So book value is the net worth of a company of equity according to the firm's balance sheet. So this would be the accounting method of equity, because assets minus my liabilities equals my equity. So that's kind of the most basic and the most, founded in actual transactions. The other stuff we're going to talk about is projections and then other elements, but the book value, this one, as you know from accounting, is found in actual transactions that have occurred. The limitations of book value, the liquidation value, the net amount realized by selling the assets of the firm for paying off debt. The replacement cost is the cost to replace the firm's assets. The book value just doesn't take into account the fact that there could be additional realization from those assets if we sold them off. It also doesn't take into account replacement cost. So elements like depreciation and other things that we use in accounting to figure out what book value is don't take into account replacement costs. Instead, we talk about historical costs instead. So Tobin's Q ratio is the ratio of market value to a firm's replacement cost. So we can look at that slide. Oops. Okay, sorry about that. So this is the financial highlights for Apple and Alphabet, and Alphabet's the overall company that owns Google. You can see the price per share, and you can see the common shares outstanding, and this is in billions. So to find the market cap, you would take the price per share times the common shares outstanding to get what the market capitalization is. This number was from obviously a while ago, because Apple by far has surpassed $1 trillion in overall market cap. I'm not sure where Alphabet is currently, but I know that they're last I checked, were over $1 trillion. So then we have sales. EBITDA is earnings before interest, taxes, depreciation, and amortization. We have their net income. We have their earnings per share. We have the price to earnings. It's a ratio, the price to earnings ratio. The price to book, so the price to book value. The price to sales, so their price per share to sales, and then their price to earnings gross, I believe PEG is. And then we have their return on equity, the return on assets percentage, their operating profit margins, and their net profit margins. All right, the intrinsic value versus the market price. So the expected, here we're going to calculate the expected HPR, which is a holding period return. And the expected holding period return is equal to the expected dividend per share plus the expected end of year price minus the current share price over the current share price. So in a lot of ways, it kind of simulates almost a percentage of return, but strictly when it comes to dividends. So a sample says, suppose you purchase a share of DAR Inc. for $40 in January. We expect to sell it for $42 in December and expect to receive a dividend of $2.42. What is your HPR, your holding period return? So we would have our expected dividend per share here being would be my $2.42 plus my $42, my expected price minus the price I actually paid for it, which is 40. So up here I'm at 442, and then divided by 240, divided by the 40. So 242 plus 2, so I'm at 442 divided by 40, which gives me 11.05% holding period return. The intrinsic value is the present value of a firm's expected future net cash flows discounted by the required rate of return. So this is a net present value, and so this is what we're talking about when we talk about the valuation being over book value. The fact of the matter is that a company is generally worth a lot more than that because the company makes money from the assets that they earn. So we would calculate present value of future cash flows and discount that back to current. Subtract the, and we would discount the percentage rate we would use would be our required rate of return to find what the intrinsic value of those future net cash flows are. The problem is the trouble with this, and we'll get into it in a few minutes, but is that future net cash flows, that company could go on forever. So they're just going to reach a point where it's really either impossible or the number gets to be so small that discounting back really doesn't add up too much. The market capitalization rate, market consensus estimate of the appropriate discount rate for a firm's cash flows, different than the rate of return. So that's the market cap rate. So the intrinsic value, we have the value, and again, we've got the expected earnings plus the expected price appreciation plus 1 over K, which is K is the rate of return. So K is the expected rate of return for holding period H. So you would have to do this. This is a present value function here where it's a dividend discounted model. So this would be the amount for year 1, and this would be for year 2, and so on and so forth. So they put the H up here for the term of the holding period for the discounted amount. So formula from intrinsic value firm, the dividend discount model of the firm equal to the present value of all expected future dividends. The constant growth dividend discount model forms a dividend discount model that assumes the dividends will grow at a constant rate. So this one in particular implies that the stock's value is going to be greater if there's a larger dividend per share, a lower market cap rate, which is by K, and a higher than expected growth rate from dividends. For stock with a market price, its intrinsic value is the expected holding period return. So dividend yield plus capital gains, and then again, we're doing our dividend divided by the prior period. This would be the price at 0.0, and then I've got my price at 0.1 minus price at 0.0, so into year 1, beginning year 1 divided by year 1, which again gives me basically my dividend yield plus my capital gains. All right, stock prices and investment opportunities. The dividend payout ratio is a percentage of all earnings paid out as dividends. So this is a method that we can use to actually figure out how much dividends might be or anticipate the dividends, so we can use one of our discounted models. The plowback ratio, earnings retention ratio, is a proportion of firms' earnings reinvested in the business. So these are kind of the opposite of one another, right? This is a percentage of earnings that's paid out. This is a proportion of firms' earnings that are reinvested. So, you know, if in a perfect world, these two should equal 100 in total, because our earnings should only go either back into the business or be paid out as dividends. Present value of these growth opportunities, the price equals a no growth value per share plus the present value of the growth opportunities. All right, life cycle stages and multi-stage growth models. The two-stage discounted dividend model, in which dividend growth is assumed to level off at a future date, which makes sense because we learned in a prior chapter about life stages, and when companies tend to mature, that's when they tend to pay more dividends. But that also usually means that they are in the later stage in life of the business, and that usually means that they are going to see some, they're going to level off dividends and oftentimes even decline eventually. So this multi-stage growth model allows dividends per share to grow at several different rates as the firm matures. I'm kind of using that for prior chapter, using that business life cycle curve to say, okay, it grows faster here and then levels off as time goes by. So considering the following information, a firm's dividends are expected to grow at a rate of 20% until for 3 years. At the start of year 4, the growth slows to 5%. So GS goes from 20 to 5. The stock just paid a dividend at time 0 of $1. The assumed market capital rate is 12%. So plugging this in to this function, you can see we come up with what's the price point of this stock currently, $21.90. So what this also tells you is that if you use one of these models, the idea is that if the stock is priced differently, then there could be some value or not value in it. If it's priced higher than that, there could be other elements at play. but it's at least one thing we can use to measure what the value of that stock is. If it's priced lower than that, then we might want to buy it because we believe the value, at least in this particular model, to be greater than what the current stock price is. The constant growth model states that stock's value will be greater the larger the expected dividend per share, the lower the market cap rate K, and the higher the expected growth rate of the dividends. Which makes sense because that's all three of those things we just talked about that would raise that overall price and value. So dividend growth and reinvestment. So dividend reinvestment. So low reinvestment, we're talking about companies that pay more in dividends and don't reinvest very much in their company. That would be this blue line. High reinvestment would be an organization that does not pay very high dividends, but reinvests more in the organization itself, usually more of a growth firm.